Hello, everyone. Welcome back for another Friday Fratarcangeli market update. No time for the weak and weary. We've had whipsaw markets moving down 2 to 3% and then right back up 3% this week, coming off of yesterday's bounce back. A lot of things going on causing that. I think the obvious would be the Fed meeting this week and some of the concerns with what interest rates are going to do with inflation still peeking its weary head. Not to mention Iran. We're continuing to go backwards as it relates to the conflict continuing. Part of the process, I would say, but we got a taste of what it felt like after, or maybe from a pause in that concern. But as we look at earnings as well, which is playing a big role, we're hearing a lot about capital expenditures and expenses increasing for corporations. So these are factors that are causing uncertainty in the market. Remember what we talked about before. This is an election year. There's a polarization going on. The media typically jumps on to the, focusing on some of those factors that can create more nerve, impact, causing us to be concerned on some of those areas. For example, we had the Fed meeting this week, and there was a lot of discussion around the lack of transparency and how that was going to affect how the market would move without knowing exactly what the Fed's next move was. Kevin Warsh came out and talked about that. He talked about the fact that he's going to wait for the data, make sure it's accurate, and then make decisions at that time to keep inflation at 2% or lower, whether he needed to raise rates, leave them alone, or lower rates. So that uncertainty and that lack of clarity is never welcomed by a market that typically prices in worst case scenario. So those factors are playing into the market volatility. And of course, when he announced he wasn't moving rates this week, there was some dissent amongst the Fed members, and that's creating uncertainty as well, which caused the market to drop over 2%. In addition to that, we've started to see earnings. We are a third through the S&P 500 earnings, and what we've seen is 80% of the companies have beat. And we're also seeing robust earnings in the fact that we're looking for a 30% earnings growth year over year. Remind you, this is the fourth consecutive year of double-digit earnings growth. So the economy is strong. We're seeing some very good things happening out there. But we have to keep in mind, as we saw the GDP numbers come in, which is an indication of productivity, which was a little bit lighter, we have to keep our eye on productivity as well as inflation. What we're seeing is a softening of inflation, but also a slowdown in productivity as it relates to the GDP, which came in under the estimates of 2.1%. Some of the factors that we have to look at a little closer there is the fact that we had a lot of purchases, imports coming in prior to the re-engagement of tariffs. And that played a role in front-loading some of that productivity in the first quarter. So we're keeping our eye on that, and I'm sure the Federal Reserve will as well. We're also going to be monitoring this capital expenditures. Let me remind everyone, the tax law changed last year and allowed 100% deductions on many expenses for corporations. So as a corporation would be navigating purchases through the coming months, they may have front-loaded some of those purchases for tax reasons. So capital expenditures are twofold: keeping up with the AI infrastructure build-out, which demands spending, as well as the tax implications that come with the benefits of spending. So we're going to see how that plays out, but I don't think those factors are being considered. I think what the general takeaway is we have to look at long-term objectives. We have to plan for the worst and prepare for the best. And I believe this volatility in an election year that we've talked about in the past is something we can take advantage of. Dollar cost average. Maybe position ourselves in some of those growth areas that have been affected negatively recently due to capital expenditures and the volatility coming from, I believe, the narrative that's out there and the concerns that I think are healthy. The resetting of the market, retrenching lower on some of these high-flying growth stocks and categories, I believe is healthy. I worked in this industry in the late 90s. I saw the market go straight up with not a lot of retrenching to retest. That was unhealthy. We had the lost decade that was kicked off by the dot-com bubble. What we're seeing today is robust earnings. We're seeing a market that's retesting. We're seeing some focus on inflationary pressures that can come back to bite us. I see this as a positive. Here at Fratarcangeli Wealth Management, we are creating a plan. We're monitoring and making sure that we're prepared for the worst potential outcome, and we're taking advantage of our long-term objectives by dollar cost averaging, reassessing where we should be relative to the portfolios, and taking advantage of the opportunities. Let me leave you with this. The second year of a first-term presidency, which is a midterm election year, historically is the least rewarding and the most volatile. On the heels of that, we have the third year. Post-November's election, historically, for that midterm, through the following December, are the most rewarding market returns of all 4 years. Let's make sure we're positioning ourselves to take advantage of that probability and not react to the noise and the fear that can be driven by that noise. Stay the course. I look forward to seeing you soon. Bye for now.